Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Joyce, managing director on Nasdaq's Market Intelligence Desk, for an update on how earnings season is progressing. We're also going to take a technical look at a number of the major indices and some volatility indexes. Brian, it's great to see you as always. Welcome back to Trade Talks. And we are in the thick of earnings season, the busiest week of the second quarter earnings season. How would you characterize overall performance?
So far so good. I think things are going very well. My focus here at Nasdaq is on the financials, which have had quite a year, especially those small and mid-sized regional banks. Even the banks are really doing quite well following their earnings announcements, which really is the sector that kicks off our earnings season with the large big banks, JP Morgan, Bank of America, the money centers, and now we're seeing the regionals coming out. And given the eye test, a lot of them are doing quite well following their earnings announcements.
And Brian, let's get into the technicals here, as you are a resident technical analyst at Nasdaq. Let's start off with the Nasdaq 100, clearly outperforming the other major indices this year.
Yeah, I mean, it's having a phenomenal year, record first half, not just on an absolute basis, but also relative to the S&P, the Dow, and the Russell 2000. Historically, that bodes very well for all indices in the second half of the year. So when we look right now at the Nasdaq 100, I would say that I think we're showing some signs of exhaustion, some buyer exhaustion. Given this phenomenal move higher, last week's reversal pattern. If you want to get technical, it's referred to in candlestick parlance as a shooting star. And then this week we're seeing something very similar where we trade higher and then we come back down and we're trading near the lows of the week. So it'll be very interesting to see how we do tomorrow and close the week out. But, again, like as I noted, we did have a very strong prior uptrend. So, when you see signs like this, it may be, telling us something that, maybe there's been a little over investor exuberance taking place here. So I wouldn't be surprised in the near term if we see, a bit of a pullback here.
And moving to the S&P 500, are you seeing a similar pattern there?
So this week we are. If you look right here at the S&P 500, the weekly pattern, this is a gravestone doji, we call it in candlesticks, and we could see we started the week off right around this level here at 45.43. Shot higher, and now we're seeing a pullback. We're actually trading below where we opened for this week. Also a strong uptrend prior to that. So that's something could be another sign that the market, is due for a period of rest, some consolidation. We do want to see confirmation, which would be next week's trade price action in the S&P 500. But as we noted with the Nasdaq 100, we did see a bearish candle last week, and this week, to me, it looks a little bit bearish as well. Its location also is quite important. We can see that for the Nasdaq 100, we're seeing these topping signals right at the prior highs that we made back in February and March of 2022, which is the early stages of the downtrend, which also coincides with the 76.4% fib retracement. So there's a cluster of technical resistance there. We are also showing some overbought momentum readings. The weekly RSI is over 73 for the Nasdaq 100, and for the S&P 500, the RSI is roughly 69. So right at that overbought level. So I think in the very near term, I think you could see some consolidation, maybe a brief pullback. I would look to the moving averages. So if we're looking at the Nasdaq 100, the 50-day moving average, we haven't tested this moving average all the way back since the middle of March when we saw the Golden Cross, which was actually the week after the bank turmoil had started. So at that time, we were looking at this level as support. We haven't tested it since, and so it wouldn't surprise me if we do see a deeper correction that could potentially test the 50-day.
Well, let's take a look at the volatility complex, Brian, looking at the VIX hitting, just 5 hours ago, 12.87. That's the lowest level that we've seen since January 22nd, 2020, right before we got into the pandemic volatility that we saw in March and April. What does that suggest to you? I mean, south of 13 doesn't sound like the market is anticipating too much volatility, but based on what you just said, looking at the Nasdaq 100 and the S&P 500, it feels as if the indices are looking to put the brakes on things.
Yeah, I mean, I don't want to come across too bearish. I think overall what we're seeing is very, very constructive price action, especially with the expanding rotation into the cyclicals and into the value groups over the last 6-7 weeks. I just think in the near term, we could see a pullback. The VIX being at these low levels is, to me, just a coincident indicator, typically what you would see when the market is in such a strong uptrend. So I'm not concerned about a spike in volatility just by looking at the VIX alone. But I do think, if we are going to see a pullback in the marketplace, then yeah, you would expect this to go higher. What would concern me is what's going on with the MOVE index, which is the rate volatility measure for the bond market, and that is not spiking higher. I think we could see back here in March, this was the second highest level that this MOVE index reached ever, going back to the early 1990s. Only in the the peak of the great financial crisis did we see the MOVE index get higher. So it was quite high in March, but it's been coming down quite a bit. Nice steady downtrend since then. And so that to me is the more important measure, even for equities, because I think if you see an increase in volatility within the rates market, I think that'll spill over into some volatility in the equity market as well.
All right, and Brian, to wrap up here, speaking of rates, let's take a look at the 10-year. One thing that's been interesting that you and I have been covering, it feels as if the equity and the bond markets are thinking about a potential recession or Fed policy in different ways.
Yeah, so the bond market, the equity market, it certainly has not really shown any signs of recession. The economic data, it's been coming out. Has been strong. Jobs numbers has been quite low. The unemployment numbers have been quite low. So jobs are resilient as well. The GDP number came out today, nice and strong. The durable goods data came out today, was very strong also. So the economic data has been resilient. It's been better than expected. I think this move higher today in rates is reflecting of today's economic data on GDP and durable goods. But we're not seeing a big move on the short end of the curve. So we're not seeing, another spike higher in the probabilities for another Fed rate hike. That's still staying around 23%, as far as the futures market pricing goes. So, I think the market for now is comfortable that maybe the Fed, could potentially be done. Maybe there'll be another rate hike down, in the second half of this year, which we're already into. But it's really the long end of the curve that we're seeing to move higher with. And I think that's just reflecting the better economic data.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.